An order block is a key zone on the chart, left behind by institutional traders, where smart money previously entered the market with significant volume. When price returns to this zone, it often reacts strongly, creating a high-probability trading opportunity because unfilled institutional orders are likely still present. In this video, we're going to break down everything you need to know about order blocks, the difference between extreme and decisional order blocks, how to identify high-probability order blocks, and how to apply them using real chart examples. If you want to learn advanced trading concepts, precise entry techniques, and smart money strategies, make sure to hit the like button and subscribe to the channel for more high-value trading content. An order block represents the final footprint of institutional activity before a strong directional move in the market. In simple terms, a bullish order block is the last bearish candle that appears just before a powerful bullish impulse. This candle marks the point where smart money stepped in aggressively with buy orders, causing price to move higher. To mark a bullish order block on the chart, you draw a zone covering the entire candle range, from the low to the high of that candle. This zone represents an area where large institutional orders were placed, and often not fully filled. Because of this, price has a natural tendency to revisit this zone before continuing in the same direction. On the other hand, a bearish order block is the last bullish candle that forms just before a strong bearish impulse. This indicates aggressive selling by institutions. Just like bullish order blocks, bearish order blocks are marked by drawing a zone from the high to the low of the candle. One of the biggest advantages of trading order blocks is the tight stop loss, which allows for a much better risk-to-reward ratio when compared to traditional retail strategies. This is why order blocks are considered a refined and precise version of order flow. Not all order blocks are created equal. Based on their location within the impulse move, order blocks can be divided into extreme order blocks and decision order blocks. An extreme order block forms at the very origin of an impulsive move, typically at the lowest point in bullish market structure. This type of order block carries higher probability because it represents the final accumulation or distribution phase before price aggressively moves away. These zones usually contain significant liquidity and imbalance, making them powerful reaction points. A decision order block, on the other hand, forms somewhere in the middle of the impulsive move. While these can still work, they are generally considered lower probability compared to extreme order blocks, especially if price has already traveled a significant distance. Both types can be traded successfully, but extreme order blocks are preferred when precision and probability are the priority. To identify a high probability order block, certain conditions must be met. Without these confirmations, an order block should not be traded blindly. The first and most important condition is a valid break of structure or change of character. Order blocks only gain significance after structure has shifted. In a bullish market structure, we look for bullish order blocks. However, if price breaks and closes below the previous swing low, creating a bearish change of character, our bias shifts. From that point onward, we stop looking for bullish order blocks and focus only on bearish order blocks. Similarly, in a bearish market structure, we look for bearish order blocks. But if price breaks and closes above the previous swing high, confirming a bullish change of character, we now focus exclusively on bullish order blocks. Without a confirmed structural shift, order blocks are not valid. Although order blocks are commonly defined as the last opposing candle before an impulse move, but it's not that straightforward. The candle color, red or green, itself is not the most important factor. What truly matters is that the order block candle should be a liquidity sweeping candle. This means the candle may be bullish or bearish, but it must be the lowest candle in a bullish setup or the highest candle in a bearish setup. No candle before or after it should break beyond its extreme. This confirms that liquidity has been swept, which is very important for a valid order block. Another critical condition is the presence of a fair value gap after the liquidity sweep candle is identified. A fair value gap is formed using a 3-candle structure, but an important point to understand is that these 3 candles are not always consecutive. Let's break this down. The first candle is the liquidity sweeping candle. After this candle, price may form one or more internal candles that remain within the range of the first candle. These internal candles do not invalidate the structure, they simply represent short-term consolidation. The second candle is the impulsive expansion candle that breaks beyond the high of the first candle in a bullish scenario, or below the low of the first candle in a bearish scenario. The candle that follows this expansion completes the 3-candle formation and confirms the imbalance. In a bullish scenario, the fair value gap is the price gap between the high of the first candle and the low of the third candle. In a bearish scenario, it is formed between the low of the first candle and the high of the third candle. The presence of an FVG confirms institutional aggression and inefficiency, strengthening the validity of the order block. The final confirmation for a high-probability order block is inducement. Inducement refers to the minor pullback that forms after a valid break of structure. This pullback traps retail traders into early entries and creates liquidity. When price returns to take out this inducement level, it signals that smart money has gathered the liquidity needed to continue the move. Only after inducement is taken, we look toward the order block as a potential trade location. When price returns to a valid order block, there is a high probability that it will react from that zone and continue moving in the direction of the major trend. Order blocks are not standalone entry tools. They work best when combined with market structure, liquidity, fair value gaps and inducement. When all these elements align, order blocks become powerful zones and increases the probability of success. That's it, traders. If you found this video helpful, don't forget to like, subscribe, and hit that bell icon so you never miss our next video. If you have any question, drop it in the comment below. Thanks for watching, see you in the next video.